Welcome back to Markets Today. My name is Mbitha Mwema and I am your host for this afternoon. In studio, we have Mr. George Munga, who is the managing partner for AMG Kenya. Mr. George is here to help us unpack the conversation on taxes. Well, when COVID-19 started, its impact was felt globally as well as locally. Beyond our closure of boundaries as well as the restriction of movement in the country of Kenya, we also had the government of Kenya extend relief to the workers as well as to just anybody who is in Kenya by lowering first and foremost the corporate tax rate from 30% to 25%. Pay as you earn, which is the income tax rate, was also reduced from 30 to 25%, as well as value-added tax was reduced from 16 to 14%. All of these measures were to just help the Kenyan populace to be able to just make it through the COVID-19 era and be able to just have a few shillings left in their pockets just to weather the storm that was up and coming. Now, this changes from January 1st. Everything goes back to normal. It's in effect not a new tax, it's just a normalization of what had been. So what is the impact of this? This is what we want to understand. So a very warm welcome to you, George, to our show this afternoon.
Thank you, Billy.
I know I wanted to talk about tax, but before we talk about tax, there are also a couple of topical issues, and we were discussing things to do with interest rates and currency earlier before we came into the show. We have seen a slight weakness over the last week, 1% down, and now the Kenya shilling is trading at a rate of 111.1 shillings against the greenback. Do you have any commentary on that?
I think the last time we saw such fluctuations in our our foreign exchange rates was in 2008, and that was because of the post-election violence. I think this was going to happen. I think we had talked about this, I think, in March, April,
yes,
that we were going to see shockers in terms of our forex rates. 111, remember between March, April, May, June, we were doing around 102, 103.
Yes.
It has gone, it went up to 108, I think, in the month of August, and now we are trending at 111. We might close the year or quarter one with around 115. That was expected because, one, our FX revenues from exports went down drastically. Remember when all the skies were closed across the world, we could not export our cut flowers, we could not export our agricultural products, even our tea, we had a problem exportation. So you realize that our forex reserves at CBK went down drastically.
Okay.
Central bank has tried to manage it. I think I would want to use the word cosmetic. They try to do cosmetic management, because if you look at the fundamentals in the economy, then 111 is even still managed rates. But that is their role. Notwithstanding, they need to manage our FX rates, because if they don't do that, then we might have what we call imported inflation into the economy, which is not a very good thing for us. Another fact that I think has contributed to this is pent-up demand. Remember, for almost 3-4 months, traders were not importing goods from out of this country, meaning those funds were lying somewhere, and when the economy was open, they had to go out there and try to source some of their supplies into the country, and that pushed the demand for foreign currency. And then you realize as you are going through the NSC indices, between May, June, July, the indices are very low, meaning we didn't have FDIs coming to the country.
Okay.
So that in effect meant that our FX reserves at CBK went down drastically, and therefore the demand vis-a-vis the supply of dollars could not match up, and that now reflects into our fluctuations.
Okay.
And then maybe lastly, our current account deficits. Remember, we were trading at between 4-3%, but by last month we had 7%.
Yes,
so that explains why
those
fluctuations are there.
Okay.
But I believe Central Bank of Kenya and by extension Treasury are going to put in place measures to try and manage it. I would expect it not to go beyond 115, and then maybe to come back to around below 110.
Below 110
to the dollar. Correct.
Okay, and that's interesting. And even when you touch on the NSC, I mean, last week and last couple of weeks, we've actually been seeing an inflow of dollar, or actually foreign demand. I would imagine that could sort of be beneficial for the currency. Is it that the volumes just don't add any value whatsoever when it comes to the NSE? Because like last week, the NSE traded about $50 million. A good majority of this was foreign inflows in terms of foreign demand, so about 40 million in 1 week. Would that have any impact?
It should have an impact and be there. But remember, they are coming at a time when the FDIs had gone down quite by very huge percentages. I remember when you're looking at the graphics, the month of June, I think it dipped so much. Yes. So I think as they're coming in to just to bridge the gap, the hole that was created by that time. So we expect as this increases, if the trend increases, then probably by the month of January, February, we should see the dollar starting to come down maybe to 110, 108.
Okay.
We are hopeful that trend should continue. We've seen companies like Safaricom attracting quite heavy demands from foreign investors, which is a good thing for the economy. Yes. So I think what NSE should go out there and do is to just reassure foreign investors that the economy is stable and things are likely to look up as we go into the new year. And then lastly, maybe on that, as we go into the new year, maybe most foreign investors want to cash in on dividend declaration by most of the companies that are the NSE. So we expect FDIs to start flowing in maybe between now and January up to March. Okay,
fair enough. Thank you so much for that overview, Mr. Munga. Now let's go to the topical conversation of the day. Last week, the government of Kenya came and said it will reinstate the taxes that it had currently reduced. That's the corporate tax, the income tax, and the value-added tax. Give us what is your perspective on this? I mean, I'm sure this was expected, but what do you make of it before we get into the intricacies of that decision?
I think these were measures that were announced by the president, I think, in early March, when the pandemic had just hit our shores. For policymakers, I expected to see now that the rates have been reduced, or those tax breaks have been given to companies and even to individuals. How is the government going to bridge that gap in terms of revenue collection? I think we didn't see that bit. We only saw the tax breaks that were given, but we didn't see what are the measures the government is going to put into place to ensure that those deficits are bridged. You realize that the major contributors to our revenues in terms of tax collections, one, corporate tax, and then value-added tax, and pay as you earn. And any slight reductions in those three tax heads comes a very big deficit that KRA reports. I think over the last 3 months, KRA report a month-on-month deficits in their collection vis-a-vis their targets, and that reflects now the impact of those tax breaks into our revenue collections. So I think the policymaker should have gone back and just interrogate the figures and see we are likely to lose this amount of money in terms of corporate tax, in terms of pay as you earn, in terms of VAT. How are we going to bridge that gap? Yes. Because government didn't announce reduction in their spending. That's the other bit. They announced reduction in taxes, but they didn't announce the reduction in spending. So if we are to reduce our revenue in terms of tax collection, then government had to come and tell us we are going to reduce our spending so that that gap is nailed out. But I think we are not yet far off. These are things that can still be rectified. Things, remember, we're still within the financial year. So I expect Treasury to come up and tell us that we are going to bridge that gap that we have created between March and December by doing A, B, C, and D. Come January 1st, remember the taxes are going back to where they are, where they were. I mean, as we were discussing off air, I think most employees will have a shocker in January, because you'll not remember that initially by March your net pay was this amount. So I think that is a shocker that most employees should brace themselves to
and don't go to HR, because we were actually saying that at this rate, HR, we have a myriad of very angry employees saying, where my thousands have they gone to? Okay. So I mean, before we go to a national level and sort of look at where are we at and why was this an important decision to make and what we expect for next year, at a micro level, at a household level, then how should individuals or businesses consider the impact of this, because it comes smack 1st of January?
At the micro level, remember VAT affects affects the amounts you spend on your household basket of goods.
Okay.
So when you go shopping, there's for every shilling that you spend at the supermarket, there's a percentage that goes to VAT. Initially, it was 16%. The president brought it down to 14% with the ESP1, but it's going to go back to 16%. So one, you expect that the price index on household goods is going to go up by around 2 basis points. So you expect not only transport, but all the other goods that we use on a day-to-day basis are going to go higher. Two, the disposable income.
Just before you go on disposable income, so will this have a trickle-down effect when it comes to inflation?
Correct. It will.
Okay.
Remember that inflation is measured by the household basket.
Yes.
And any slight increase in the index affects the overall inflation in the economy. So definitely it will.
Supply side impact.
Correct.
Fantastic. Thank you for that clarification. So what about disposable income?
I was going to the disposable incomes. For most people in this country, we rely on employment income. And with the reduction with a 5 percentage point reduction on pay as you earn, at least that disposable income went to the pockets of the populace or those who are working. With the reintroduction of the rates as they were, then you expect that your income will go lower by that same quantum. Remember, your income is going to go lower, while general prices in the economy are going to go higher. So at the end of the day, we'll have our disposable incomes will come down. So as you were saying off air, this is a time to try and preserve as much cash as you can, because 2021 is going to come in with several shockers in terms of our income. So it is a time to focus maybe in the next 1 year. How much cash can you save, or how much cash can you conserve, so that you can be able to go through these shockers. Okay. Remember, the last bit that I want to talk about was turnover tax. Turnover tax was introduced by Treasury, but before it was implemented, the government came in. In fact, it was supposed to have been implemented by 1st January 2020, but it had not been fully implemented. I think that was the phase that they were trying to implement.
Exactly.
And then with ESP1, the president came in.
And that's the economic stimulus program one.
Yes, the president came and suspended that tax for the 9 months.
Okay.
It is going to come back in January. So for small traders, they should be aware of this tax. That from 1st January 2021, they're supposed to pay 1% of their monthly turnover to the government. That is, if you sell 100,000 for the month of January, you are supposed to go and pay 1,000 to the government. Okay. So this again will still affect the disposable incomes of the populace in the economy. So I think, as you were saying, that this is a time to try and conserve as much cash as you can, so that as you go into the new year, at least you have a buffer to absorb some of these shocks that are going to come with these reviews.
But isn't there a paradox, Mr. Munga, because at a micro level, that's you and I, we are conserving cash, or the mindset and the practicability of this season that we're in is hold back on cash, don't consume as much. But you have put out an important point that says the government of Kenya is not cutting back on its expenditure. So isn't there a paradox, because I am cutting back, they're not cutting back, which means I'll keep being taxed. Debt will continue being an issue. So then when we come to the macro level, how is the macro looking? Because it's becoming a very interesting conversation, and there are risks that we are already aware. You're saying they have to increase this tax because they're not meeting their budget estimates. It's not easy to cut back on expenditure at a national level, because it's not like going to your house and say we are not consuming this. There are already things that have already been budgeted for, and we're already in the cycle of building up into another budget season come June of next year. So then how do we look at it at a macro level? What are the benefits of this change? What are the risks of this change?
I think at a macro level, the government is in a catch-22. One, because the economy is already in a recession, and for you to pull an economy out of a recession, normally the most effective tool is to increase government spending. so that you can increase the demand, the level of demand, the purchasing power in the economy. But this is coming at a time when government revenues are down there. That is why the government is forced to review some of these tax laws, so that they can have money to spend. If government spends and spends efficiently, then you'll start seeing the economy growing. The only challenge that I know the government has is that it's already overborrowed. So they don't have a very big latitude or a very big headroom for them to borrow. Remember, our debt portfolio is already at 7.5 trillion,
yes,
and our sailing is at 9 trillion. So meaning you only have a headroom around 1.5 trillion,
which so they'll expound in less than 12 months. Actually,
correct. So I think the government is in a catch-22. And I'm foreseeing the debt ceiling being reviewed again probably for June next year to maybe 10 or 12 trillion. But this is a time to try and be as efficient as possible in your management of the economy or of the resources that you have. But I bet you not, if government can spend efficiently and ensure that its spending go to the right sectors of the economy and there's minimal wastage in the chain, then the economic impact will be realized in 3 or 4 5 months. The challenge we have with some of our governments, especially in Africa, is the inefficiencies that we have that are built into the system. So that if Treasury was to release, say, 100 billion shillings, what eventually goes into the ground is less than 50% of what Treasury releases.
Okay. George, I like talking to you about the economy because you sit in a space where you do advisory for small and medium as well as large corporates, and then you are also an economist / an accountant in your background. So it's an easy, it's a very interesting space to be in, where you're like, how does policy impact business? Now, I know in theory, the best practice is the government needs to spend so that there can be a flow of money into the economy. Government is spending. We are seeing construction going through. Whether they're going to pay it on time, that's a conversation altogether, because it's just not, that kind of liquidity is not there. But now, when you come to the SMEs that you engage with, the businesses, whether large, whether micro, whether medium-sized businesses that you interact with, what do they need for the next 12 months to thrive? Because I hear us talking about this conversation of VAT and corporate tax and a tough economy that the government has to deal with. And I hear us talking about an economic stimulus package. If you were to actually go to the government today, are there 2 things that you have identified that you're saying, hold everything aside, in my experience, this is what these companies need to thrive, or even though it's not the government intervention, in my experience as a business, given what's happening at a national level and what's happening with the economy, these are the 2 things that you must absolutely consider and review or integrate into your current business model to thrive for the next 12 months.
I think as I was saying, that government is the only institution that earns money by spending, but by spending it in the right sectors, in the right way. In Kenya, over the last 2 or 3 years, the government has been spending, but the spending has not been right. The way the government has structured most of its spending is most of our big projects, sorry to say, are funded by the Chinese government, and some of these transactions are done offshore. We only get the implementers coming to the country, meaning the funds are negotiated offshore, they are paid offshore. So what eventually lands in our country is very minimal. That is why you see very mega projects in the economy, but with very little impact in terms of economic growth. So my thinking is the government needs to review this so that most of these transactions are done locally. If we are doing, for example, what the government is currently doing, that is the expressway, maybe the government could contract a Chinese contractor to do maybe 60% or 50%, and the rest to be done by locals. I believe there are local companies that can do such projects. So if that is done, then you'll realize that most of these companies have cash, 1, to purchase raw materials locally, and 2, to even employ locals in some of those projects. I want to refer you back to I think that was 2009, 2010, when the Kibaki government was trying to do an economic stimulus after the post-election. What they did, is that they open most infrastructure projects to the locals, such that an SME would be given, say, a kilometer or even half a kilometer to do. With that, they're paid 3-4 million. If you do that to say 1,000 or 2,000 SMEs,
yes,
then you realize that the economy starts to grow. People start having cash flows in the economy, and you'll get some other sectors now growing. Like, for example, you saw that time the real estate sector was growing very rapidly because people had disposable incomes. But when you transact some of these contracts abroad and the monies are paid abroad, then what you have here is just implementation. Then you'll have very mega projects with very little impact in the economy.
Okay.
Yes.
All right. Fantastic. So I think there's so many moving parts, and there's no one particular answer that can make it right.
Correct.
But now today, if you look at the economy next year, what is your outlook? What are you telling businesses to do? I know you've told us at a personal level, at a micro level, conserve cash. How are then businesses operating? And I know one of the greatest challenges for businesses is the line item account receivables, where you're sort of either working for the government and then your delayed payments, if it's the county disbursement of funds, if it's at the private sector level, just there's always that constant delay. So then how do businesses evolve and sort of just remain as a going concern for the next 12 to 24 months?
I'd like to say this. For those who have studied science,
yes,
if you're boiling water and it has reached its boiling point, it can only cool down.
Okay.
For our case, I think in terms of economic recession, we reached our lowest,
yes,
so it can only go up.
Okay.
That is the advantage that we have going to 2021. Remember, at the beginning of this year, government had projected that is going to grow the economy by around 6.3. It was reviewed downwards around 5.2, and then 3 points, and then currently it has 0.6% growth.
Yes.
We might record a negative growth for 2020. If that happens, then most probably in 2021 we might experience maybe 1 or 2 or 3% growth.
Okay.
As the economy grows, the citizenry or the business that operates in that space also grows.
Okay.
The other advantage that we have as Kenya is that we are a leader in this region. Most countries look unto us for direction in terms of economic growth. So I think there are opportunities that are going to come with the new year. You've seen companies starting to pick up, albeit slowly. But come 2021, I think quarter 2 or quarter 3, you'll still see companies revenue starting to go up again.
Okay.
So the comfort that I have as an economist or as an economic analyst is that we've reached our lowest point in terms of economic growth, and we can only grow from there. So companies should look at the better side of the prism and just see what are the opportunities that are there come 2021, and how can we manage how can we exploit the regional economy to our benefit.
Okay. And then in terms of the company that you run, that's AMG Kenya, you do a lot of consulting with companies. Are there some services that possibly people can reach out to you for in terms of business consulting and planning for the year or 2 years ahead?
I think ours, we major on in one is audit, and then tax, and then strategy, which is very big.
Okay.
We've done strategy for countries for companies that are out of Kenya. We're doing a strategy for a bank in Ethiopia, and just looking at what is it that what are the opportunities that there are with this pandemic. Are there even opportunities? I think when you start brainstorming on those, then you realize the opportunities that a company can exploit.
Okay.
Remember last time Cooperative Bank launched a digital platform.
Yes,
so you can open an account without going into the bank. Those are the opportunities that this pandemic has brought to us. So if you look at the positive side, then you realize that there are several opportunities that this pandemic has given unto us, and as Kenyans particularly, I think economies outside Kenya looking unto us to provide solutions, and we need to step up and just do that. Remember the other time I was telling you about SMEs piggybacking on the bigger corporates to look at the prints outside of of our economy. Remember, Equity Bank went to, I think, DRC the other day.
Yes.
It has gone to Rwanda, and therefore there are opportunities in those. Yes, there are opportunities in those those economies. That as Kenyans we can go out there and exploit. And when you come to the digital or the ICT subsector, I think we are also a leader in that subsector. And ICT has very huge opportunities in Africa, and especially in East Africa. So that's a region that that's an area that I think companies can exploit just to earn more revenue as we go into 2021. Yes.
All right, thank you so much, George. That's all the time that we had, but I would like you to sort of finish off with a parting shot in as far as now taxes and then just reinstatement of that and what that means for businesses, and then we can close, come to the end of this particular show today.
I think my parting shot is the taxes. We are given a tax break for this year, but government has resolved that they're going to go back to the taxes as they were. It is not a risk per se, because that is what is supposed to those are the risks that are supposed to be there in the market. So I think this is a time, one, to, as we said, to conserve cash so that you have a buffer for those shocks as they come in next year. But then again, as I was saying, the economy is starting to look up. I would want to challenge the Kenyan business community to start looking at the opportunities that not only are available within our borders, that's Kenya, but opportunities that are outside of our borders. We have several economies that are surrounding us that have several opportunities, especially in ICT, manufacturing, even telecommunication.
Okay, fantastic. Thank you so much. That's all the time we had today. That was George Munga, who is from AMG Kenya, talking to us about the impact of the reinstatement of the corporate tax and the value-added tax. Certainly, it is the end of a year, but what George is saying is that when water gets to the boiling point, the only way it can do is cool off. So we've gotten possibly to our worst in terms of the negative GDP growth we saw this year. Possibly there could be an uptick in terms of growth and output for next year. Cash is king, but open your eyes to the opportunities that are out there. That's all we had from us today here at Markets Today. Thank you for joining us, and see you again same time. Good afternoon.